Good afternoon, everybody, and thanks for joining us this month for our Riffin on Real Estate call. And this month I'm joined by Garrett Smith, who's one of the portfolio managers for our Income Opportunities Fund, IOFIX, from Alpha Centric. Garrett, thanks for joining us this afternoon.
Thanks for having me.
Garrett, it's September. NFL opened last night. We're a couple of weeks into college football. It's always an exciting time of the year, especially with what's going on in the markets. Um, Before we kind of dive in to, how we think that this is going to impact the legacy non-agency space, let's just kind of talk for a minute about kind of what's going on a broader level with the Fed and those types of things. So obviously, next week we've got a decision. I think it's supposed to be on Wednesday as far as what the Fed's next move is going to be. With the weak jobs report last week, it would appear that it's a pretty safe bet, at least today, that they're going to lower. So, that being the case, talk about how that would impact some of the other areas in fixed income that investors are going to have their eyes on.
Yeah, I think we're at an inflection point or getting close to one. And so kind of typical things that occur during inflection points is you start to get mixed data, probably increased volatility, and markets, can be a little bit binary. And that's kind of what we've seen the last few weeks. For a while there, we were still getting some decently strong economic data. And I mean, you want to throw in some of the fireworks with Powell and Trump. Really hard to tell what the Fed was going to do. The markets have pretty much priced in a cut in September. But then got a little nervous that maybe that wouldn't happen. Also, future cuts, were I guess downplayed as well. And then, as you mentioned, we got some rough jobs numbers, which is really what the bond market needed to relax a little bit. And what that tended to do to the yield curve, because the September cuts pretty much priced in, but the worry about future inflation dropped quite a bit. Most signs are pointing to a slowing economy, some weakness in the jobs market, inflation being under control. And so what we saw was a flattening of the yield curve. The 30-year was just kissing 5%, and
Right.
a basis point away, maybe two. And historically people buy it then, that's kind of a good support number. So that's about as high as we get on rates in at least recent history. And now it's down to 469. The 10-year yield dropped quite a bit, now just above 4%. So money coming into bonds, but I think that kind of binary outcome still exists. If we get another strong jobs number, some strong economic data, we can kind of see that go back the other way again. But all indications is that rates going to go lower, the Fed's going to start cutting. And so people are getting ahead of that trade. To kind of answer your question more directly in fixed income, obviously people have been putting on duration bets, which basically just expose them to rate moves. And I think people have pushed a little further out. The kind of popular spot to be in the yield curve was kind of 5 to 7 years.
Mm-hmm.
And that flattening is indicative of people pushing further out, taking on some longer bets. The general trend of spreads, and so to kind of take a step back, I mean, typically in bonds, we'll break it into pieces. You got your risk-free return from treasuries, and that's driven by interest rates. And then let's say you take high yield or corporate bond risk on top of that. The additional yield that you require, would be due to credit risk. And that's where I think some dislocation could happen. as the stock market has been on fire, the earnings have been strong. It's kind of feels like late 90s, like nothing can go down. You get that kind of environment, people chase yields and spreads get
Right.
really narrow, and they're not really getting compensated for a whole lot of risk. High yield is being priced like IG, investment grade not long ago. And I kind of get it with the older high yield, when some of those companies have pushed out their terms and they've grown over the last few years, but new issue, high yield, very tight. Um, there's not a lot of places to go there, I think. People are starting to look to the little bit more esoteric areas, like non-agency RMBS, asset-backed securities. You can get, pretty good IG returns and ABS right now. Takes a little bit more work, a little bit, perhaps a little less liquid in some circumstances. But people, if they want any sort of compensation for taking credit risk, that's where they're headed.
Before we shift gears, what has it been like historically with the Fed? When the Fed has started a lowering cycle, has it? I mean, they don't do an about face. I mean, that hasn't really happened, has it? Where they've lowered and then all of a sudden, oh, gee, we made a mistake. We're gonna start raising again.
Usually not. That's a good point. And what's a little kind of contradictory to the rhetoric right now is we've gotten really used to bad news is good news.
Right.
And so, a terrible jobs number, along with a, cooling economy is generally not a good thing. But it's what everybody was looking for, waiting for. So it was like, yay, we got bad news. But really that's a sign of a future risk, and a worsening economy. Usually that's a great time to pour into bonds. But it'll be interesting to see what happens to credit spreads if companies, don't remain as strong, if the consumer isn't as strong. There should be some more risk in the economy, and I don't think a lot of that's being priced in.
Okay. Let's kind of shift gears then to your bread and butter, this whole legacy non-agency RMBS area. So, with what we think is going to happen next week, talk about the impact that you see on this asset class, and particularly as it relates to excess spread and loss write-backs in the asset class.
Yeah, it's kind of fun to take a bit of a step back. The original opportunity in legacy post GFC was really created because of the complexity of the bonds. They weren't all that complex in an environment where, like things are today, where nothing goes down, everybody's feeling bullish. But with housing dropping, 20, 30%, all of a sudden the nuances of those bonds move front and center. And that created a lot of the opportunity in the space. As things have progressed, though, the bonds have certainly changed. I mean, now you're looking at, instead of houses that are underwater, like in the subprime post-crisis era, now you're looking at homes that are, have 50% equity in them. They're amortizing down. Home prices have gone up. There's a ton, backing these bonds. But the complexity remains, and I would kind of break that into two parts. I mean, one is very straightforward. It operates like any other bond, where interest rates go down. That's typically good for the bonds. Prices go up, and so forth. But in these in particular, though, there's a point in interest rates, and we saw that a couple of years ago, where if rates get high enough, there's not enough interest available from the homeowners to pay all of the interest. And to kind of explain that, the coupon the bonds pay float with interest rates.
Right.
So if the homeowner's paying a pretty fixed amount, interest rate level, and that coupon exceeds now the interest coming in, now there's a shortfall. There's not enough interest coming in to pay the bonds off. So it kind of gets an extra kicker. It's like an option. It almost looks like an option where rates got to a high enough level to where now the bonds in this asset class were really getting hurt to a greater degree than just your typical bonds
Right.
because of that. So when interest rates are high, not only maybe you not be able to get all of the interest due, but you also have no what we call excess spread. And one of the benefits from 2008 until 2022, 2023 was that the interest coming in from that kind of fixed home payment was much higher than the really low coupon being paid out in a zero interest rate environment. And all of that extra interest gets used to pay the bonds off sooner. And you end up with your assets are still there, but you're paying off the debt now. Instead of a 1-for-1, now you've got extra assets. And so any losses that occurred during the great financial crisis can get paid back. And a lot of these bonds, because of that, can get multiples of par. You're not just getting 100 cents back in the dollar. You could get 110, 120, 200%, 400%, whatever. So so that even adds further into this kind of extra optionality with interest rates, but it's above a point. I think of it like an option. It's like there's a strike price, and rates were higher than that. When the Fed cut a couple times last year, that brought us pretty much like at the strike price. So some bonds paid back that lost interest. Some bonds have excess interest. Some are still shortfalling a little bit. As the Fed cuts interest rates, that should unlock a lot of the value in this space. I mean, assuming they do. That's our view. I think that's kind of the broader view. The Fed cuts interest rates. Now, all the bonds should be getting the interest they're due. There's some that have been accumulating interest for 2 or 3 years now that's due that'll get, start getting lump sum payments. And then, if we get further rate cuts, now you start to develop, get back into that excess interest where the homeowner's paying the fix and the rates are lower, and we start to, move the expected return, instead of getting 100 cents to 100, and, we're probably about 110, 120 equivalent right now, but it could go higher. And so just like higher interest rates hurt worse, a few years ago, this area stands to benefit, much better than just your typical bond going forward if rates go lower.
It really sounds like this whole thing has kind of been reset, if you will, back almost a decade.
It has, yeah, and yeah, for better or worse. I mean, it would, yeah, if you held it the last few years, it's been a grind, but now, yeah, we're back to really, depending on the situation, at least high single digit yields. I think there's potential for double digits in a lot of spaces, and also, with bonds too, you usually don't see like a linear increase in price. If you own a bond at 70 and you think it's going to go to 140, and it's around for 10 years, and you're like, I'm just going to go up this much every year. That's not really the way that it works. In part because the bonds get safer as they get older.
Right.
Amortization. And that's right. Yeah. And so, I mean, you can. I'd love to argue with people about what's safer right now. You can even think like U.S. debt. In some cases has some credit questionality to it. A house that has, to exaggerate a little bit, 75% equity. I mean, how do you not get that money back? So as these bonds get older and their risk becomes less and less, you think of it in its last couple of years, it's got 98% equity. That's not, that should be very low yielding, low risk bond. The price should be really high, close to its terminal value. And so prices, can increase earlier, faster in earlier years. And so I think there's potential also to kind of trade the space and get some outsized returns, especially over the next 5 years.
That's great. So, Garrett, we're gonna have to leave it there. Thank you so much for joining us today, and thank you all for listening. I think we've got some topics for our next call, so we'll look forward to doing that again here in the next few weeks. Until then, thanks again for joining us.